What if you could earn money just for owning a piece of a company? Sounds too good to be true, right? Well, with shareholder dividends, it's not only possible, but a common way for investors to earn passive income. But how exactly do dividends work? And how do you calculate how much you could earn? Whether you're a seasoned investor or a beginner, stick around to learn everything you need to know about dividends and how to make them work for you. Let's start with the basics. Shareholder dividends are payments companies make to their shareholders, typically from profits. Think of it as a company's way of sharing its success with you. But did you know dividends can also apply to a savings account? Some credit unions or savings accounts offer dividends similar to interest. It works like this. The bank shares a portion of its earnings based on your account balance. While the payout is smaller compared to stocks, it's a safe way to earn a little extra. Next, let's talk numbers. Calculating dividend per share is simple. Divide the total dividend payout by the number of outstanding shares. For example, if a company pays $1 million in dividends and has 500,000 shares, each share earns $2 in dividends. Understanding this helps you evaluate how much income you'll receive from your investments. Not all dividend stocks are created equal. Comparing dividend payout history is crucial when selecting a stock. A company with a consistent or growing dividend history is often a safer choice. Check how long they've been paying dividends and if the amount has increased over time. While dividends can be an excellent source of passive income, it's important to understand that they come with their own set of risks. The first risk to consider is dividend cuts. Companies that pay regular dividends can sometimes face financial difficulties or changing market conditions that force them to reduce or even eliminate their dividend payments. This can happen during tough economic times or if a company's earnings decline. Another risk is dividend stability. Not all companies offer consistent dividends. Some might increase their dividend payouts over time, while others might fluctuate or stay the same. A company with a long track record of stable or growing dividends is often seen as a safer bet for investors looking for reliable income. Dividend investing is a strategy that can be incredibly rewarding, especially for beginners looking to grow their wealth over time. But what exactly is dividend investing, and how can you get started? Let's break it down. In simple terms, dividend investing involves purchasing shares in companies that pay dividends to their shareholders. These dividends are typically paid out in cash and can provide you with a steady stream of income, which is especially valuable if you're looking to generate passive income or reinvest those earnings for even more growth. To get started with dividend investing, you'll need to check the company dividend yield, which is the annual dividend payment divided by the stock price. A higher yield can be attractive, but keep in mind that too high of a yield might signal a riskier investment. Once you've selected your stocks, you can either take the dividends as cash or reinvest them back into the stock to purchase more shares. This strategy is known as dividend reinvestment or DRIP. Over time, this can help you compound your earnings and accelerate your wealth building. And there you have it. Don't forget to like, subscribe, and share your thoughts in the comments. Thanks for watching, and I'll see you in the next video.